Right, today I'm sharing with you 3 legendary pieces of investment advice that every single investor out there should know before they make any investments. Many people don't know these 3 pieces of advice, and honestly, it baffles me that many people make investments without knowing these 3 things. But once you know what they are, hold them with you for the rest of your life and use them to your advantage whenever you make any investments. Now, I first learnt these 3 legendary pieces of investment advice from one of the world's most successful investors, and I'm now passing that knowledge on to you, so do make sure to stick around till the end. Hey, what's up people? Welcome back to our channel, Ralph Finance UK. So let us get straight into it with the first piece of legendary advice that every investor should know. So the first piece of advice is all about the consensus is built into the price. Now this one is best explained with a very simple classical example. Let's say you want to bet on a horse race, and let's say there is one horse that everyone is pretty confident will win. He's a strong horse with an excellent track record. Now let's say there's another horse in the same race who is lazy and he's never won a race before. So I ask you, as an investor, which horse do you bet on? Now most people will say the strong horse is the right choice to bet on because he will probably win. Now, although this is true and the strong horse is very likely to win, that does not necessarily mean this is the best investment, and that is because of this very principle of the consensus being built into the price. Let me explain. Let's say if you bet £1 on the lazy horse and if he wins, you win £1 million. And now let's say if you bet £1 on the strong horse and if he wins, you win £1. Which horse do you bet on now? Most people would now choose to bet on the lazy horse because on the off chance that he does win, the upside is huge. Whereas the other way, you're very likely to win, but you do only win £1. And this all works because the consensus is built into the price. The consensus is that the strong horse will win, and the upside of that horse winning is reflected in the reward. I mean, it's only a £1 win. No one thinks that the lazy horse will win, and again, the odds and the reward reflect this. If the lazy horse wins, then it is a £999,999 win. So what does this all mean? Well, this means that a terrible company can be a better investment than a terrific company, just like the terrible horse can be a better bet than the strong horse, because it's the odds that are changing. So if everyone believes something's going to be terrific, then everyone is betting on it and its price is pushed high. So the first thing you need to take away from this video is that the best performing company or asset may not necessarily be the best investment. You may find a company that everyone thinks is going to go up, but if it is so overvalued because the consensus is built into the price, then it may be better for you to invest in a company that is so undervalued because no one has faith in that company. But that is a company that could offer a huge upside on the off chance that it does well. I mean, let's take Tesla. Tesla is a phenomenal company. There's no real doubt that it's one of the best companies we've seen this year. But as an investment, that is an entirely different question. And this is one of the key mistakes people make. They think that a great company is a great investment. But if you think back to the horse example, you realize that a terrible company could be a great investment. Now moving on to the second piece of legendary advice. You've got to understand investing is a zero-sum game. When you make money, there is someone else out there that has lost money. The money isn't just created out of thin air. And when you lose money, there is someone out there who has made that money. Wealth can't be just created or destroyed. It is just transferred from one person to another. So in order for you to win in the game, the investment game, not only do you need to pick good investments, but you also need to realize that you are playing against others. And when I say others, I don't just mean any other investors, I mean people like Warren Buffett and Ray Dalio, who are regarded as 2 of the world's greatest investors. They are also in the game. And Dalio has actually said, it is very difficult for you to beat me or to be others who are putting 1,500 people and hundreds of millions of dollars into winning that game. And he even went as far as to say that it's more difficult to succeed in the markets than it is to succeed in the Olympics. He basically made the remark that people don't just suddenly decide, oh, I'm going to compete in the Olympics, because people decide it is no easy task. But when it comes to the markets, everyone wants to jump right in because they think it is easy money. And so when we have the average retail investor coming in and picking individual companies, only looking at the short term and trying to time the market, it is pretty much a recipe for disaster. And so the second thing you need to take away from this video is that when you're investing in the markets, you are competing against many institutional investors who employ thousands of people and invest millions of pounds. So how are you going to compete with the likes of Warren Buffett and Ray Dalio? Well, this is exactly what the third legendary advice is all about. So the third piece of legendary advice is this: every individual investor needs to know how to diversify well. Ray Dalio, one of the world's greatest investors, has said knowing how to diversify well is more important than almost anything. And going back to investing being a zero-sum game, we know that wealth doesn't change. When one asset class goes up, another one comes down. When one asset class is overvalued, another one tends to be undervalued. And the undervalued one is usually the one that no one is talking about. So what you need to do is diversify your wealth in countries, diversify in currencies, diversify in emerging markets, in index funds, in REITs, in commodities such as gold, in case the monetary system breaks down. I could go on. And you need to pay attention to your downside. Everyone is looking for a one great investment, but you really should be looking at an entire portfolio. And Dalio actually said that the thing about risk is that people often don't comprehend it when it comes to their investing style. All they can think about is how much gains they can make. And it's only the experienced investor who's been through his fair share of rises and declines who knows the importance of risk. Now, if we look at Dalio's portfolio, although he has invested in many individual companies, if we just look at some of his largest investments, we see that he has invested into the S&P 500, which is the top 500 companies over in the US. So his one investment is across 500 US companies. And anyone who believes in the US economy as a whole would want to hold this investment. So even when we look at the portfolios of some of the largest and best investors in the world, we see their portfolios are packed with index funds and ETFs, which are just packages of thousands of different stocks. And these allow investors to be exposed to a diverse range of sectors, countries, and economies. And it's this diversification which allows investors to significantly limit their risk. And so you don't feel that you have to dedicate all of your portfolio to individual companies. Now, there's absolutely nothing wrong with investing in smaller, more riskier companies, and that's usually where the huge upsides lie, but they do come at a higher risk. But you'll also find that's where a lot of fun lies, because investing just in index funds and the likes can be a little bit boring. So experienced investors typically tend to invest a large portion of their portfolio into diverse funds, and then that smaller 5 to 10% of their portfolio into these smaller, more riskier companies that could 5x but could also go bankrupt as well. So if you believe in the UK economy as a whole, you'd want to invest in the FTSE 100. If you want to be more diverse, you can invest in the FTSE 250 or the FTSE 350. If you believe in the US economy as a whole, invest in the S&P 500, which gives you exposure to the top 500 companies in the US. If you want to be even more diverse in the US economy, you can invest in the Russell 3000. That is the top 3,000 companies in the US. If you believe gold and Bitcoin will continue to surge, then there is plenty of gold investment funds for you to invest in, and recently we've seen a Bitcoin investment fund as well. If you believe a certain country is in its growing phase and everything is thriving there and companies are flourishing in that country, then you can invest in an index fund which gives you exposure to that country. You can also invest in emerging markets funds which give you exposure to multiple growing countries such as India, China, Brazil, and so on. And the same goes for continents as well. If you think Europe as a continent will do well, then you can invest in the Stock 600, which is the 600 largest companies in Europe. If you think the electric vehicle sector has good long-term prospects, then there are funds for this as well. We also have REITs, real estate investment trusts, which I've made a whole separate video on. You have real estate, commodities, the possibilities really are endless. And then we have that smaller 5 to 10% for these smaller, more riskier companies. Maybe there's a company that you think is innovating a new technology that you think will change the world, and you think they could see huge growth. Then you can put a little bit into that. Maybe there's a company whose service you see a huge demand in all of a sudden. Then that could also have a small place in your portfolio. Diversification is the most important thing if you know how to do it well. And so if you take just one thing away from this video, that is to diversify. So overall, you need to go out there and find yourself some undervalued opportunities and invest, and then hold your position for the long term. Pick investments that you believe will have long-term growth, and then watch as your investments grow. Don't try to time the market and panic sell at the slightest drop, and then of course have that smaller 5 to 10% for these individual, more riskier companies. If the investment drops in value, then provided you are still satisfied with the fundamentals of that company, you can use this as an opportunity to buy more shares at a discount. While everyone else does the panic selling, you can use this as an opportunity to set yourself aside. Again, don't try to time the market and try to buy when the investment has bottomed out just so you can buy at the biggest discount. Just buy it as it drops. As it drops more, you can buy more aggressively. We've seen time and time again the people who try to time the market are the ones who end up buying at the peaks and selling at the drops, because they end up trading with emotion, and you'll find they end up doing pretty much the opposite to what institutional big time investors are doing. So when everyone else is buying, question yourself, do you actually see this as a good investment opportunity, or are you just simply following the hype and letting your emotions do the trading for you? Remember that it is a zero-sum game. You are competing with the world's best investors, and so in order to limit your risk, you should diversify your bets across multiple investments. Overall, it is a lot about mindset. A lot of people get caught on the hype as things are going up, and they're automatically wired to think that whatever has done great recently must be a good investment, rather than viewing it as expensive. And anything that hasn't done so great recently, they immediately think, let's stay away from that investment, even though that could be an undervalued opportunity. Now, the fact that you're watching this video till the end already sets you aside from the majority of people, and so if you found value out of this video, which I really hope you did, then hit that thumbs up button. That way you get more of our videos recommended to you, and also hit subscribe if you don't want to miss our next video. I'll see you on the next one. Take care.